by AS14, which actually has become so archaic when you compare it to the ones internationally found. And that's why I think he took the liberty of stating that it's manageable, and that was the way it was, because you had no other answer. Of course, you could go back to the international standards and start looking at what to do in such situations, but you are bound by the law. You couldn't go and apply IFRS or US GAAP or IND-AS was never there, so to Indian GAAP scenario. Having said that, I think the presentation moves okay, so by the time he does that, the objective of this standard basically is relevance, reliability and comparability of information. Now these are all terms which are embedded into the standards, and the principles of recognition and measurement. One has to understand that this will, the way in which you will apply business combination standard over whichever engagement that you pick up where there is a possibility of an acquisition that takes place. What is it that you will need to take care of? Last week when we started off with IND-AS, you were given the flavor of fair value. Now fair value, Jamil also made a statement that there is, you don't get carried away with fair value, but the point of the matter is that you have to face fair value. And more so in this standard than anywhere else. Obviously there's a fair value measurement standard by itself, but you will have to therefore percolate all the fair value standards in the various IND-AS wherever a concept of fair value arises. So you have to look at these standards in that perspective. Normally I have a habit of reading the standard every time I need to make a presentation, at least once before, so that you get a flair at every time. And that's why I carry it with me, okay? And this is not just printed fresh, it has been read a couple of times because there are my markings, which I will show you. And I keep on doing this always. So how many of you have read IND-AS 103? 2 people here? Jayesh bhai, don't ask me. Zubin, obviously, he's an avid speaker. So 2 people in the audience, huh? Now, that is not the way to study IND-AS, any IND-AS for that matter. Okay, if you have not read IND-AS 103, have you read any other IND-AS? No. So, actually my question was, how many times you have read it? But I changed the flavor to just present it in a way that how many times. Okay, fine. Now, this is the standard, and this is what is all there. Okay, this is an encapsulation of what is found here. Don't get carried away. This is printed 1 page on not back to back. So it would only fit in 45 pages if it was done that way. And out of the 99 pages or 90 pages that are there, 30 pages are examples. Okay, so it's only 60 pages of standard. This is 103. But if you read what Mr. Kulkarni will talk to you in some time, that is 300 pages. So again, out of that 100 pages is example, but there is 200 pages of the standard that's talking about embedded derivatives and financial instruments and so on. So this is very small standard, 60 pages, okay? But it has to be read. Now why I made the emphasis is because nothing, you have to go back to this all the time. Yes, this is theory, but it has been written in a very lucid language that you can absolutely follow it in your day-to-day, even if you don't, if you've not read it once, your first reading also will be a light reading. I can promise you that. It's not going to be tough on your reading. So do read that, because there are certain factors in it which I would like to highlight, and that's here also, that We are going to discuss the principles for recognition and measurement of identifiable assets. These are new terms, but nothing any different. Non-controlling interest in the acquiree. What is non-controlling interest? Minority interest. Liability is assumed. Goodwill acquired or a gain from a bargain purchase. Now, either you say goodwill or you say negative goodwill. Negative goodwill is not a term which we use in India. It is used internationally, but people have started using it, or you find a bargain purchase option. Now that's a very rare scenario. Normally it's a very rare one, but you know, when you're working, you might only start with a rare one to work with as an assignment. So you have to understand that. Now, the disclosures. The more I speak, the less you will want to listen to me on disclosures. So I'm not going to talk about what you have to disclose. Please go and read the disclosures of all the public listed companies internationally, and you'll understand what it is. Of course, after having read the standard says only so much. It says this disclosures, but those disclosures have to be in spirit. You just don't have to mention the name and the figure, etc. So that's what it is. So these are 4 important things that we will deal with. This is the overall impact of IND-AS, which is summarized here. This is not part of the standard. What is the impact? Because fair value of assets. Of all assets, the word is all. Purchase price allocation. How many of you know what is a PPA? Yeah, I'll take from you your understanding of PPA.
So when you are acquiring some assets in a company, on a slump sale basis, then you account in your books of account at a fair value. And the remaining portion you attribute to intangibles, which can be identified intangibles or remaining is attributed to goodwill with other unidentified intangibles. So that is you are allocating a purchase price, but you are going to tangible and intangible.
Yeah, why did you use the word slump sale? That is making it restricted. It can be any acquisition, so any type of an acquisition. Purchase price allocation is nothing but allocating the purchase price, the consideration that was paid for the transaction over various assets and liabilities, as he rightly said, with an addition that now, as these group of people have done in AS 14, you said this was the consideration paid, this were the net assets, and therefore the balance was goodwill. So that was all that was there in the standard. Just about 3 pages. Okay? That was there. This minus this goodwill. If it was the opposite, it's negative goodwill. That's it. Now this goodwill figure is not a big chunk. It's now to be broken up. That's where purchase price allocation comes to more importance, is because you're breaking up the goodwill into another set of intangible assets, but mind you, the identifiable, as rightly said by him, and as we said in the earlier slide also, identifiable assets acquired, the identifiable intangible assets. So you break them up. So basically you will say, if an X company paid something for another company, and that goodwill was the figure, was the excess amount it paid, it did not pay just because it loved each other. There was a reason why they paid. So that reason is now to be put up on your financial statements as part of the elements. So it's as simple as that. So just, you're now breaking up the goodwill into various factors. And what are those factors? There are those intangible assets. This is a summation of impact of IND-AS, volatility in post-acquisition profits. Now you will automatically think that once you have more assets identified and you have amortization procedures, that's a very simple one because you know what you will do. But the impact of business combinations is that whatever you do thereafter, once the business combination is over, everything is a transaction through the profit and loss account. And that's why you will see volatility, and you will, from quarter to quarter. Right? We were talking to one company in Hyderabad 3 days back, and the CFO tells me that, well, our dynamism has increased to 1 acquisition per month. 3 M&A teams working together in an Indian company. So if that be the case, and imagine at least they may work on 3 acquisitions one per month, but they will be at least completing one by one every quarter, or maybe with two every quarter. So you can imagine what happens to the, there is nothing sacrosanct about it. So you keep on, and there is no seasonal date now for the finance department. It's an ever exercise available. Why do I put an impact as your use of experts as an impact? Is because everything is not going to be under your domain knowledge. When you talk about identifying and measuring intangible assets, first of all, it has to draw upon you that there is an intangible asset. Then the fact, how do you measure that intangible asset? Now, this can, if there are experts within the organization, the companies per se, good enough, but as far as I know, very few people are available, and you do require a lot of market data. You require a lot of comparable data. You require a lot of analytical process involved through valuation techniques, which needs to bring up. So therefore, you have to imagine that this is also a consulting and accounting firm or a CPA firm or a CA firm doing in cognizance of this, assisted by valuation experts at one end. So it's going to be a lot of people involved to get your business combination done across. Just a very quick one, that there was no guidance available for accounting under AS 14. Comprehensive guidance was not available, but this clearly defines business combination. We covered two types of amalgamations in the nature of purchase and merger. That's all what we did in 14. But this requires that assets will be acquired, liabilities will be assumed, but you have to remember that it has to constitute a business. Because acquisitions are not necessarily stock acquisitions. They could be asset acquisitions, right? I could only be interested in buying the assets, and not necessarily, because stock purchase comes with its own issues of liabilities and things like that. So many deals are actually asset acquisitions. Now, it changes from a seller to a buyer. What does the seller want? What does the buyer want? Because seller may say that I am happy with the stock sale. The buyer will say I'm happy with an asset acquisition. And that's where the negotiation card draws. And then you have tax impacts accordingly. That's where your word of slump sale becomes very important from an Indian concept, because that's the word which is used normally here. But that's how it is. So there are tax impacts on both aspects, and they become the negotiation, key parameter for the deal.
Can I question you Khozema, or later on?
No, you can.
Again, coming to measuring the intangible, the slump sale word used by him, that was the only time that we guys used to think how assets need to be allocated.
Right.
Now, when this comes in, I mean, it's how, like, goodwill for me has always been an intangible. How do I break this up? Like you said, you need valuers. You need to understand what has to be taken as intangible.
Right. I'll be discussing that. I think that the core of business combinations is only that. All right. Absolutely, and it is, and that's the maze, and that's why I'm telling you this is the heart. Spend more time on this. If you can add value as consultants and as corporate guys also, if you can state that you can do something like this and have lesser dependent on consultants, you still make a buck on your performance bonus, right? Okay. So all amalgamations are business combinations is what 14 said. That's not the case here. It's not like that, because it has to constitute a business. Now, it applies to all business combinations. Please understand that once you say it's a business combination, then it applies. Okay, so applies to all business combinations. The earlier slide said not the vice versa. So it has to be whatever you are getting in, whatever you are going to buy, that has to constitute a business and not just an asset. If it's just an asset, acquisition IND-AS 103 is not applicable. Okay, that's pretty simple. I'm just making it as simple as possible. So then asset acquisitions are ruled by other IND-AS. You go to other IND-AS wherever applicable and start doing your. In any case, fair value will come in, but it will not be under the garb of IND-AS 103. These two transactions are beyond the scope of IND-AS 103. One is formation of a joint venture. We will deal with this in the next Saturday. And acquisition of asset which does not constitute a business. That's what I just said. All right. Now, these examples I'm going to take a little later because I want to drive home some points through this slide.
So before you go into business combination, I think I just would like to mention is AS 14. Everybody, I think a lot of people have said that they have applied there. The lacuna there is that it also talks about purchase method, it talks about pooling of interest method. Right. But I seldom see that purchase method is being applied.
Perfect, perfect.
So here actually it will be a reverse way. Seldomly you will be able to apply pooling of interest method. Right? So that is where is the major change in my view. Second change which is there is that we had intangible standards, but a lot of intangible assets as such was not getting covered in those standards. Now when we apply IND-AS, there will be a lot of intangible assets which you need to, at least in case of a business combination, you need to ascertain that, carve out that. So what is going to happen is that your goodwill which remains will be a minimal thing. I think when I talk to a lot of corporates, their major problem today in India is that when there is a goodwill on consolidation, it's a large amount of goodwill on consolidation, and that is arising because you are not doing the purchase method. And then the question comes that I want to apply the international standards, and in that it says that goodwill is not required to be amortized. If the same goodwill, if you would have taken as a part of tangible or intangible assets, you would have amortized them. Okay, so India wants, based on the world, they are saying that goodwill will be large, and goodwill then you will apply it to the international standard that it is not required to be amortized. The major issue is going to be faced for that, and that is where now when the going is not good for some of the industries, you find that large amount of impairments are coming into the books of account. I think that is where these standards will, from the beginning, will be able to give allocation to the fair value and amortization. Sorry, it's quite important.
I would love this interaction. More importantly, I'll catch a point from there and ask you a question. How many of you have got yourself involved as auditors and have faced the corporate for an impairment analysis? What this has been your...
Generally, they don't want to reduce the book values.
That's the most, nothing new. What else?
Mostly debtors or loans and advances which are actually no longer receivable.
What happens to the goodwill that was there in the books when you ask for an impairment? What were you doing earlier? The AS 13 was what I believe, and with a permanent diminution criteria. That permanent diminution was the way out. Everybody said, I'll give you a study. Oil and gas even says that. Oil and gas says that there is no permanent diminution, so there is no impairment at all. There is no question of my investment going haywire when the world has crashed on all of it. I mean, that is what, and that's where you are carrying assets and liabilities on your books in India in a different scenario. And when IND-AS comes in and it tries to erode away all of this, I remember one CFO telling me in 1999 when we were doing their US GAAP restatement, okay, a fancy restatement, not required at that point in time, but the listed company asked, they said, and they got tired of us. They said, you've been here for, your firm has been here for 6 months, and all our years of restatement have happened. Please go away, erode my capital, erode everything but go away. We know that nothing will be left with us. So that was the way. But that was some years ago when there was nothing else but Indian GAAP. So you can imagine what is still lying on our books, just to take a point from that. Okay. Now, and pooling of interest method, what he said is, of course, we can touch upon, but the reality is very important because you will be using pooling of interest method only for those business combinations which are counted for as called common control. Now, How many of you have faced common control transactions? 1, 2, 3, 4. All right, 4 people. That's more than the earlier ones. I'm happy that there's 4 people. Okay. This is the rare cases. These are very rare. I mean, there'll be too many because family businesses in India, but in business combinations, how to use it is a rarity. How many of you have touched base reverse acquisitions? That's interesting. Okay, we'll see. Now, this is all language. It's as simple as input plus process equal to output. What they're trying to say, no jargons, I don't want to use all of these things. The most important thing is the judgment should be that you are entering into a business deal. Basically, you're acquiring a business. And what constitutes business, I mean, cannot be defined. This is the way it has been defined, that when there's an economic resource that creates an output, when a process is applied, is all fine. But what you understand in the normal language is that, well, this is a business. The example that helps you is that a billing payroll isn't a process, they're not processes to create output, they're support functions. So if you do not have that and you have given it and outsourced it to somebody, it doesn't mean the business does not exist. The business very well exists, and if it is dealt with accordingly, you will take care of it. So this is just trying to tell you, drive home the point that IND-AS 103 will not apply in case of an asset acquisition, in case of a joint venture. It will apply in all business combinations. Repeatedly, I'm telling you, because first work is to identify whether there is a business. Only then the standard comes into picture. Number one. Number two is then to identify who is the acquirer. So is it difficult to find out who is the acquirer in an acquisition? Okay, what does normal common sense say? Who is the acquirer? Yes. Who pays me the consideration? Who else?
Beneficial.
Okay. UBO.
Who acquires the assets.
Okay. Yes? Somebody? It's a mixture of all of these. Well, it is a mixture of all of these. But then you need to decipher at a point in time when common control transactions happen, because at that time the scenario changes. That we'll see as we move ahead. So we just want, I'm trying to give you those pointers so that when we talk, you try and embed the process very smoothly. This is if you ask me, it's a very simple standard. We haven't seen it over the years. It's very practical. It's lively. It's better than all the others put together, the mundane ones, which you read, you will fall asleep. So this is interesting.
So basically shareholders will take control.
Yes.
Will be the economy. The group of shareholders who will take the control, if you talk about 2 companies and or 3 companies, whoever has the ability to control the merge entity, that will be the economy.
The key word is control. Control will be looked at in different terms when we look at whether power is controlled, whether power has enough rights for control. We look at these things because these are important at a point in time. Earlier you said that you do, when do you consolidate as per Indian GAAP? When do you consolidate? When do you consolidate?
There is subsidiary.
When do you consolidate? When? Yeah? The word of control is not required because there was no control concept in Indian GAAP. So don't give me new words now. That is here. So when did you consolidate? Earlier. There you are. He said that you are holding 50 plus 1. So 50% plus 1 share is good enough for you to consolidate. That was a mathematical formula. No longer so. No longer so. You may hold more than that, but not necessarily that you will consolidate. Okay, so keep all these macro things in your mind when you're looking at these things. You'll get the feel of the whole aspect. And rightly said, shareholders acquiring control. Yes, the word is control. And then you will be acquiring for consideration. You will have given asset, and you're taking the assets. You're also assuming the liabilities, and therefore you work out the goodwill, etc. Let's look at this in another nutshell. Whatever you have in your books, please don't refer to them and turn pages. There's nothing that's all there for you to read. It's an analysis. This is the synopsis. Please just concentrate here. The accounting topic, this is the accounting topics that you need to know: the business combination, what happens under business combination, and what happens under asset acquisition. I've not confused you with all the standards and the various numbers there. So you'll understand that when you want to recognize identifiable assets and liabilities, you will use, and if it's a business combination, you will measure them at fair value. Whereas in the case of an asset acquisition, total cost is allocated to individual items based on the relative fair values. It's the same thing, but there's a slight difference when you look at it, because here you're looking at it as a business, whereas here you're looking at it as an individual asset. Goodwill or bargain purchase is not recognized in the financial statements, and any reason why? Because you're paying the price for an asset, actually, so you will designate the entire thing to that asset. That's the fair value. So where is the question of any balance arising? Okay. Whereas in the case of business combination, you're buying a business, and that's where you pay a lump sum in the negotiation, and then you pinpoint the purchase price allocation. So is that clear to everybody that what we are talking about? Because if you have this in your mind, you're absolutely clear that one company wants to acquire another company, and making it as simple as that, and that company which acquires, for the simple reason it is the acquirer right now, is paying a price, and the price that it pays is X. That X has to be divided into assets, liabilities, identifiable assets, and then your goodwill or a negative goodwill based on this, and then how to account for that. Transaction costs have to be expensed. Now, in the past, we used to always have a fight for this matter, because there was a grey area in totality, even internationally. But now it's just to be expensed, period. Nothing doing. No, all Indian companies are used to putting up assets on their balance sheet and then say miscellaneous expenditure to the extent not written off something long, and preliminary blah blah. I have never seen that. I don't know. When you see that, you start laughing that this never used to be there, and now people are happily have to do it because it's not allowed. Okay, but that's what is there in your balance sheet now. You need to get rid of these assets which are not assets. So again, in this case, they will be capitalized because obviously it's an asset acquisition. So you are giving the cost to each particular asset, and you're going to amortize it or depreciate it based on what the asset is going to be. Deferred tax. This is the key. I would say here are the challenges. I will not say in any other place, but here are the challenges. Because this is unplugged, I guess. You recognize the deferred tax asset or the deferred tax liability as on the opening balance sheet date. What is the opening balance sheet date? Anybody wants to pick a date? What's the opening balance sheet date? Common sense, don't bother about IND-AS, just tell me. Huh? The day of the acquisition date balance sheet is the opening date balance sheet, because that's what you want to do. As of that date, you need to recognize deferred tax assets and liabilities on the opening balance sheet. Therefore, it means that you have to go back and get those things organized and come to. So, if you had heard me correctly last time, I said prepare the tax balance sheet. Prepare the tax balance sheet, and again I repeat, prepare the tax balance sheet. Your life will be simple. If not, then it will be as complex as ever, as I just made the statement. So this is a learning. I told you go home and do it. How many did it? Nobody. So everybody is so interested in their own work, but they all want to learn IND-AS, and this has been the story for the last 25, whatever years that I speak. The reason is you don't have to go and apply to a client or pick up anybody's balance sheet, pick up your own balance sheet and prepare a deferred tax, prepare a tax balance sheet. Simple as that. It may be as simple as 2 adjustments. In your exams you used to have those long questions, and then you had adjustments, and then you used to do the plus minus and all that. Do that. if you don't do it on a complex balance sheet, you will be lost. And you don't not going to have simple balance sheets with the clients, I'm sure about that. Okay, now it's going to take time because I want to do the example. Okay, till the time he comes up, let's move because we have now, as we said, identifying the business combination. So we know that the assets acquired, liabilities assumed will constitute a business. Once you've done that, now the acquisition method. That's what Jayesh Pai touched upon. What is the acquisition method? You've heard about both purchase method and pooling of interest method. And he said, and rightly so, you never means hardly has anybody followed purchase method. You always follow pooling of interest method. What is pooling of interest? Add up everything together. That's all. Okay, nothing else but as simple as that. Now I'm saying that is the rarity. But now we have to use the purchase method. So that is, so in a business combination, again, so what do we first decide? Whether it's a business. Then we know it's a business combination. Then we come to IND-AS 103. Then we decide whether to do purchase method acquisition or to do pooling of interest method acquisition. Because you should have a macro, right, in first of you, then only you can go to the next steps. Then you got to identify the acquirer, as he rightly pointed out. Then you have to determine the acquisition date, right? Because what is the acquisition date? It's an important scenario. It's not going to be a cakewalk. He said it in simple terms, but to determine the acquisition date is an important element also. Then you need to recognize and measure the identifiable assets, the liabilities assumed, and any non-controlling interest in the acquiree. Then it becomes a little more complicated if I say, what if you already had some stake in that particular acquiree before you became the full acquirer? So you may be holding 10%, right? But now it's a full acquisition. So the impact of that will also be taken up in the macro stage. And then finally you recognize the goodwill or whatever. So all these steps have to be taken care of. We'll go back to some examples because I have spoken about this, and now if I immediately talk about it and go to the example, all chartered accountants have an answer is ready. But now this is the testing that you do in the study papers in the ICAI exam. That's the way I did this. So I come back to this question. The answer is very much below. I leave it to your judgment whether you want to read the answer first or the question first. No, I'll tell you why. Because I studied the other way around. When I did the study papers, when I did my study papers of ICAI, I did the answers first. Because I came to know what was expected of me in the paper. And that's why I then I read the question and I could repeat the answer in the way they wanted it. Alright? That was an administrative and an academic way of looking at things. Today, if you want to do it, you can still do it, but then choice is yours. There you are. It's a question about whether the acquired entity constitutes a business. Because that's what the first thing that you have to do, right? Company A acquires 100% of the equity and voting rights of Company Q, which owns 3 investment properties. These properties are multi-tenant residential condominiums, they can be anything, subject to short-term rental agreements that make an obligation to Company Q to provide substantial maintenance and security services, and these are outsourced to specialized providers. The company doesn't do it, okay? So remember that. And it has 5 employees who will deal directly with the tenants and then with the contractors to resolve the normal, problems. And now these employees are also involved in a variety of other matters like lease management tasks and marketing activities, etc. The question is, what constitutes the business? Good, it went off at the right time. Tell me, what constitutes the business? Generally,
renting out of the property industry.
No, but is this a business? If I were to acquire, it says company blah blah acquires Company Q. Is Company Q a business?
No, you haven't defined anything else that the company does. Possibly it only does this and it does rental business.
This is what it does. This is what it does. Now you have to find out that if the acquisition is happening, is Company Q a business which I can read through so that I will apply IND-AS 103.
Since only has only 500 and all the operations are done through contractor and outsourcing, you can't be considered as an business.
It's a business.
You have taken up a exam? No?
It is a business.
Reason?
Reason behind because I am earning money and I am spending up for that. So it's a revenue generating unit for me.
How many with this guy and how many with that guy?
So can I ask one thing, that when you make an investment, as a personal investment, you are earning, right? Then you have to go to the employer, you will say that I am not doing the business. Isn't it?
Sorry.
If you are employed somewhere and if you are making your investment for your personal gains or personal income, whether you will show that as your business. So earning is not the criteria for a business. Investment also is for earning money, right?
I use the word revenue generating unit. It is the purpose and motive does matter. If I am as an individual, if I am investing for business, like daily trading is also